take that as a yes. Okay, thank you for being so understanding with the travel difficulties. I made it as far as San Juan the day before yesterday, and was told that I could not get to Dominica before Friday, given the conditions. So I appreciate the flexibility and going the Zoom route. I've prepared a presentation to walk through the study I did for DOMLEC on the weighted average cost of capital. This study was filed last year sometime, and we've been we've been iterating with the IRC and their consultant for the past several months, and I think we've converged on a middle ground that is acceptable to DOMLEC, and hopefully the IRC and hopefully the public will receive it well as well. Basically, I've walked through this, just basically gone through some first principle discussions, capital structure, the cost of debt and the cost of equity, which are the two principal sources of capital for DOMLEC at this point, and then just a brief discussion of how we've worked to kind of synchronize the various approaches. At a very economics 101 level, the cost of capital is the opportunity cost of your investors, both capital and debt, that they have. Basically, the economic reality says that if they can sell their investment here to get a better return for investments of similar risk, they will do that. So the company really needs to set a cost of capital to be able to track capital investment, both debt and equity, so as to be able to operate and maintain and expand the electric system in a safe and reliable manner. Debt and equity, as I've already mentioned, are the sources of capital. The debt cost is relatively straightforward. DOMLEC either issues bonds or takes out loans with banks, and the cost of those bonds and loans are directly observable as the interest rate that DOMLEC pays on any of those loans it's taken out or the bonds that it has issued. Unfortunately, with the cost of equity, it's not that simple. It is the opportunity cost of equity investors. It's not directly observable, and the typical means by which these costs are estimated is looking at stock market data, because that basically underlines the selling of investments and purchasing of investments, and from that activity you can glean the return. Excuse me. You can glean the returns that investors are expecting. And then the weighted average cost of capital is just the weighted average cost of the debt and the equity. So these two formulas basically say the WACC. I'm going to call it, whenever I say the word WACC, I mean weighted average cost of capital. The WACC on an after-tax basis is equal to the percentage of debt in the capital structure times the debt cost percentage plus the percentage of equity in the capital structure and the equity cost percentage. The debt percent and the equity percent add up to 100%. So your capital structure consists of both debt and equity, and what the capital structure says is, okay, what portion of that is debt, what portion of that is equity. The difference between the pre-tax and the after-tax amount is, you'll notice in the last piece of that formula, is that the company needs to pay income taxes on the equity returns. So the equity return is divided by 1 minus the tax rate, and that increases the cost to account for the income taxes that need to be paid by DOMLEC to the government. How this WACC is used in the rate process, it's basically one of the key elements of the revenue requirement that determines how much revenue the company needs, and that consists of the elements of operations and maintenance expenses, fuel expenses, independent power purchase expenses, the depreciation expense, which you've already had a public consultation on, and then the rate base times this WACC on a pre-tax basis. And the rate base is just, it's primarily the hard assets that the company has invested in, the transmission and distribution system, the generation assets, the buildings and things like that. And in addition, it includes some working capital items, and there are credits for things that monies that the company has received that can offset that. And those items include balance on customer deposits and deferred income taxes and then capital grants. Those are the three principal ones that are credited against the assets and the working capital balance. The importance of setting the WACC properly. You don't want to get it too high and you don't want to get it too low. And the cost of, if you set it too high, electricity prices are higher than they need to be, and that's never a good thing. And eventually that comes around to adverse impacts on both consumers and the economy on the island. So you don't want to go too high. On the other side, if you go too low, that has problems too. It's nice to have low electricity prices, but if the prices result are too low, they're insufficient to adequately fund investment, maintenance, operation of the electric system, which can result in poor system and reliability and availability. You can have insufficient cash flow to pay dividends to investors. For example, DOMLEC Social Security system. And there's some private investors own about, those two together own about 42% of the company, and the government owns 52%. So it's important to have some dividends in the foreseeable future. The company hasn't paid dividends in quite some time. And then if prices are too low, that can result in the inability or difficulty to access debt and additional equity investment at competitive rates. So lenders will need a higher interest rate, and if you're looking to attract additional equity capital, they're going to want a higher return. And so you don't want that situation either. And that's of critical importance because accessing new capital when things like Maria happen or things like that is fundamentally a very important thing. And then all those things, poor reliability, bad electric system, dividends not being paid out, and things like that, those things also can have an adverse effect on consumers and the economy in the long term. So the main point of these last two slides is that you want to get a reasonable number that's neither too high nor too low, and so it takes a fair amount of discernment and discipline to strike that balance, and that's why you have a regulator, because it's important. Capital structure piece is the first thing you have to kind of settle on when you're talking about the WACC, and for the study. The 2022 year-ending balances were used in the study, and equity was 90.7 million EC dollars at that point, and the debt, that's debt and preferred equity is just another form of debt, so you can ignore that. DOMLEC does not have any preferred stock out, preferred bonds out there, so it's just debt for DOMLEC, and that balance was 79 million EC, where for a total rate base 169.7 million EC. And those numbers just fall into the bottom categories. Of 53.4% of the capital structure was equity, 46.6% was debt, totaling 100%. In reviewing this with everybody that's kind of looked at the study so far, nobody had any concerns or difficulty with that. The equity structure of a utility typically falls in that 50 to 55%. If you look at some benchmarking, and DOMLEC was right in line with that. So there were no difficult issues to work through on that. Everybody kind of accepted these numbers as reasonable. Any questions on the capital structure before I move on? Okay.
No questions.
Okay, good, thank you. The cost of debt, as I mentioned earlier, this is directly observable, and like the capital structure, this slide here looks at the average balances of December 21 and 22 to discern the cost of DOMLEC debt, and there was no controversy on this either. Most of the debt is at 5%. There's two pieces that are at 4.9%, and the weighted average of that debt cost turned out to be 5% even. And that's the case. I'm not sure where debt costs are headed in the future. I know interest rates have been a little bit high. There is some hope on the horizon that they might be falling a little bit. So, you know, I think right now, if the last time I asked DOMLEC the question, I think the cost of new debt was more than 5%, but the existing debt is 5%, and I think you know, that's a good number to use considering the interest rates. Well, first, that's what the debt is actually costing, and if new debt were to be issued, it would probably be, you know, in that same neighborhood. So there was no issues or controversy with that. Okay. Now comes the big onion that we have to unpeel, the cost of equity, which is there is no definitively correct answer on this. So typically, the approach uses two approaches are typically used, and these are actually in the IRC guidelines. One is called the capital asset pricing model, which looks at the variability of stock prices for specific companies against the variability of stock market prices for the market overall, and discerns, you know, if they're less risky, the company is assigned a lower return. If they're more risky, the company is assigned a higher return in the model. I'll get into the actual mechanics of that in a little bit. And then the second method is something called the discounted cash flow, and that approach basically says that the current stock price of the company is equal to the discount of the future cash flows from dividends for that company. And the cost of equity in that model is the discount rate in that discounted cash flow calculation that says the future cash flows are equal to the current stock price. And both models have their pluses and their minuses. They should yield fairly consistent results. Discounted cash flow models, because companies don't have uniform dividend policies, tend to be a little bit more variable from high to low, but on average they should yield a result that's similar to the capital asset pricing model. And the way these things are typically done is you find a peer group of companies that are on an actively traded stock exchange, and you can work the magic and the mathematics and discern what that cost of equity is. For the Caribbean region, unfortunately, there's not a large number of investor-owned utilities. In fact, DOMLEC is now kind of a hybrid utility. It's kind of half investor-owned, half government-owned, which complicates things a little bit. But in addition to that, the only investor-owned utilities that I'm aware of is the Grand Bahama Power Company, Jamaica Power, Grand Cayman, Barbados Light and Power, and Grenlec down in Grenada, although Grenlec was taken over by the government, so that's kind of in a hybrid situation as well, because their public policy stances. Yes, we've been taken over by the government, but we're going to operate as a private utility, and they're working through the details on that. So that's one issue. There's a small number of companies. The other issue is these companies are either part of a bigger company that is not really super comparable. For example, Grand Bahama Power and Barbados Light and Power are both owned by a Canadian company called Emera, which you're probably familiar with because you were used to be owned by Emera. And Emera trades on the Toronto Exchange, but that value is more based on their operations in Nova Scotia and Florida than it is on the two small companies in the Caribbean, so that it's not super comparable. The companies that are traded on stock exchanges, the other problem is the trading is so thin and infrequent that there's insufficient data there to use the techniques. So because of these data problems, basically the approach that is typically taken is you use a peer group of utilities either in Europe, Canada, or the United States, and you filter them as much as you can to maximize comparability with the situation in Dominica, in the Caribbean region and other regions of the world. This is the practice, and then typically there's adjustments that need to be made. One is for country risk. Obviously, with events like Maria and having such a small size, an investment in DOMLEC has a very different risk profile based on its location in Dominica than American Electric Power does, being located in Columbus, Ohio. So that's the country risk is one thing that needs to be adjusted for, and then the other thing that needs to be adjusted for is the size of the company. DOMLEC is a 15 megawatt, maybe 16 now, megawatt peak company. That's the size of a large customer or a small city block in these other companies. So the risk to DOMLEC from being so small, those risks can't be played off with other parts of the company. So, and there's finance theory that suggests that smaller companies do face larger relative risks than larger companies. So those two adjustments I made in the study. So working through the comparison group logic, I worked with the US data because it's the one I have the most knowledge of and most easy access to. I started with the group of, there's 40 publicly traded investor-owned utilities that are classified as electric utilities. So that's what I started with. I started with all 40 of those, and then I filtered those to make things as comparable as possible. There was a handful of companies that I excluded because they were not primarily electric. There was a company, for example, I don't remember the name of it exactly, in the Pacific Northwest that was classified as an electric utility, but it was roughly 70% a natural gas utility and 30% an electric utility. So there was a handful of those that were excluded for that. In the U.S., there's been a lot of market liberalization, and as a result of that, many companies have sold all their generation assets and have just become distribution companies. So they're no longer vertically integrated, and so you'd be comparing DOMLEC, which owns both generation, transmission, and distribution, to company that is either just generation or just distribution. And, you know, the risks of those two businesses are very different, and DOMLEC has elements of both of those in it, but just looking at one, there's a comparability issue. The other issue that we have in the United States is that the New York power pool, the Pennsylvania, New Jersey, Maryland power pool, the New England power pool, and ERCOT, which is the Texas market, have fully implemented competition at the retail level, in addition to being mostly not vertically integrated. There are some companies that are vertically integrated, but customers in those jurisdictions are able to choose their electricity supplier, and the suppliers compete with each other for that. So they're not fully regulated. So companies in those power pools were also excluded because they have a very different kind of risk profile. This was just a kind of a arbitrary, well, not arbitrary, but there's some logic to it, but there are some companies, even by US standards, that are just massive in size. Duke Energy, American Electric Power, NextEra, which is Florida Power and Lights. There's about 4 or so of those companies that are just so massively large that they were just excluded because they're just really not that comparable. And then there was one company, it's Detroit Edison, I can tell you which one, that I excluded because the city of Detroit is a very different animal than your typical electric utility. Everything's underground. All the load is within, you know, probably 3 square miles of the center, and it's just a different type of animal. Now, Con Edison in New York would have also been excluded for this, but they were excluded because of bullet number 2. And these are the companies that, after all that filtering, we wound up with 13 companies, which is a decent number to benchmark. You get good results. One is Elite, which operates in the Wisconsin area. Alliant Energy, which is in the Pacific Northwest. Vista, I believe, is also in Wisconsin. Black Hills Corporation is in South Dakota. Hawaiian Electric passed through the filters, and that's good because they're an island-based utility. CMS Energy, I think they're very multi-state. Idacorp is in Idaho. Oklahoma Gas and Electric is in Oklahoma. Otter Tail Power is in Minnesota and North Dakota. Pinnacle West Corporation is in Arizona. P&M Resources in New Mexico. Portland General Electric Company is in Oregon, and WEC Energy Corporation is in Wisconsin. So those are the peer groups that made it through those 3. Those are the 13 companies that made it through those filters and were used in the study. Now, the capital asset pricing model is typically estimated using that variability in the stock price, and it's basically the cost of equity is equal to the risk-free rate, which is an investment that an investor can make minus without any risk, virtually assured to get your money back. And that risk-free rate is typically assigned as a U.S. government bond of a term that is representative of the investments that a utility makes. So it's typically a longer term, and the utilities make investments that last 20, 30, sometimes 40, 50 years. So typically a longer term bond is made of that. Plus, this concept of beta, which I'll talk about in a little bit, which is basically the relative variability of the stock price to the market as a whole. Basically, a beta of 1 basically says that the stock's variability is exactly equal to the market's. If a beta is less than 1, it basically says that the stock doesn't vary as much as the market and therefore has less risk. A beta greater than 1 means that the stock price is more variable than the market as a whole, and therefore has more risk. So that beta is a number that on average equals 1 for stocks, but for utilities, it's typically less than 1. Utilities being regulated entities, they have less competition and things like that, so the beta for a utility is typically less than 1. Anyway, that beta is then multiplied times something that's called a market risk premium, and that is equal to the return of the market as a whole. Stocks on average give you this over time. If you had a completely balanced portfolio, you could expect to make X% on the stock market. And typically the index that's used to measure that is the S&P 500 minus that risk-free rate. So basically you'll see if the beta does equal to 1, that cost of equity just collapses to the return on the S&P 500. If it's less than 1, the return is less than the return on the S&P 500. If it's greater than 1, it's greater than the S&P 500. Any questions on that? Okay.
Mr. Vinhage, we will have a question and answer segment following your presentation, following you and IRC's presentation. So you can go right ahead and present. Afterwards, we will take questions from stakeholders.
I'm not making out what you said. I apologize. The audio on my end is very muffled.
Okay. Continue your presentation. After your presentation, there will be an opportunity for stakeholders to ask questions.
Okay. The CAPM risk-free rate, as I mentioned, is usually considered to be the return associated with a U.S. government bond with a term consistent with the investment being considered. Utility regulatory proceedings typically will use a 30-year bond, although some prefer shorter-term bonds. The average of the 30-year U.S. government bond for the 6 months ending May 2023, when this study was kind of finalized, was 3.74. Recently, the 30-year bond is now up around 4%, so this study will give, using current rates, would give a slightly higher number, but it would just be slightly higher. One of the things that typically get talked about in these things is whether you should use a 10-year bond, a 20-year bond, or a 30-year bond. We had the good fortune when this study was coming together that the yield curve was close to being inverted at this point. So the choice of 10, 20, or 30 was largely an academic one without any material impact on the results. The total market return. Now this was a topic of some debate. The long-term historical averages are the accepted norm for CAPM in the U.S. anyway. Short-term averages have some downsides in that they're very volatile. If you're doing rate proceedings, 1 year the forecasted return could be 7%. The next time it could be 15%. And if you use short-term numbers, you can get some choppiness from one rate case to the next rate case, and having some stability in that revenue requirement does have some advantages. The long-term average of the S&P 500 from 26 through 22 year to date is 12.01%, and it's pretty much been right around 12% for quite a long time. You'll notice that somewhere around 1960 it settles in at 12%. It doesn't move that much. This period here was the Great Depression and World War II. After that, it's kind of settled in at 12% is kind of the number. It might be 11.7 one year, 12.2 next, and you have big years and down years. So choosing that average is, you can see where if you choose a forecast and that forecast is wrong, you can get a result that could be way off. too high or too low. Now the beta estimate, this is where the complex math starts to come in. The beta is basically the covariance, which is a big fancy word, of RS, which is the stock in question, and which is the return of the stock in question, and then the return of the S&P 500 divided by the variance of the S&P 500. So it's the covariance of the stock price of the S&P 500 divided by the total variance of the S&P 500. Beta estimates from published sources are available, but each source has its own set of issues and challenges that are not necessarily ideal for a utility process, including sample sizes that are pretty small because many of these sources aggregate their data to using just monthly or weekly frequencies. Most of them use monthly numbers when they're calculating the betas, and there's some issues with using month-ending numbers, particularly especially in the U.S. in December and November. We have two major holidays, and the markets can be a little bit funky on those 2 months. So 2 of the months can skew the numbers a little bit, although probably not a ton. A lot of them also use time periods that are relatively short. Most of the published sources use betas that are calculated with monthly data over a 5-year period. So they're estimating the beta with just 60 data points for each company, which is fine if the issue with these companies, and I get why they do it, is they're looking to give investors some general guidance. They're not looking to set electricity prices, and they are calculating these betas for thousands of companies and republishing it every single month. So the beta estimate, unless you have a really big supercomputer, which maybe they'll work to that, but even so, it's just a large undertaking. The other thing about the companies is they make ad hoc adjustments which may or may not be appropriate for regulatory proceeding. For example, Morningstar takes the beta and they take a weighted average of the calculated beta and 1 to what they're saying is they want to eliminate outliers, both high and low. But what happens is and this is particularly problematic for utilities, if your beta is less than 1, the Morningstar adjustment will move the beta higher than the actual data would indicate, and resulting in higher prices. So that's just one example of an ad hoc adjustment made by companies that may not be appropriate. And every company also uses, well, most of them use the S&P 500, but some of them use a broader index. Some of them use the Dow Jones Industrial Index, so you're not really sure what you're getting unless you really dig into the details of their calculations and how they get it. For purposes of this study, I downloaded 10 years of daily stock market data through September of 2022. So I've got there's roughly 2,000 trading days in a year times. So I've got 20,000 data points for each of the stocks that I use to calculate the betas. And for the peer group, these are the betas that came out of that analysis. They range from a low of 0.51 for Wisconsin Energy to a high of 0.89 for Otter Tail Power, and for an average of 0.66. So that 0.66 is what I used in the study. Most of the studies I've seen done in the U.S. in regulatory proceedings, that number is very close to 0.7. So this is actually a little on the low side. So what I did is using 12.1% as the market return, 3.74% as the risk-free rates, and the betas on that page, these are the resulting unadjusted. These do not include country risk adjustment or company size adjustment yet. So these are the estimated costs of equity for the 13 companies in the peer group. The average of that was 9.17%, a max of 11.05%, a minimum of 8.5% first quartile, breakout of 8.55, and a third quartile of 9.62. So half of the numbers fell between 8.55% and 9.62%. The discounted cash flow model. This is a fancy math thing that basically says the stock price, today's stock price, is equal to the future stream of dividends, basically the dividend in this year out to infinity of discounted by this thing called K, which would be the discount rate that make that expression true. And that K is the discount rate, and that would be the cost of equity. There is a formulation of that which is called the constant growth model, which I did not use. It's a much simpler way to do it. It basically collapses to the discounted cash flow. Cost of equity is equal to today's dividend rate plus the future constant growth rate for the company. So example, if a company had a current dividend rate of 5% and its growth rate was that those dividends would increase 5% annually ad infinitum, the cost of equity in that situation would be 10%. It's just the sum of those two numbers. That, in my opinion, given that we have a lot of information from investment houses and short-term forecasts for these companies, is a bit simplistic. I prefer to do something called a two-stage discounted cash flow calculation. And basically what I do is I take the current stock price, and what I did is I took the most recent 2-week period. Just if you pick one day, stocks do weird things on one day, on a single day sometimes, so that 2-week just kind of averages out any short-term noisiness in the data. And then on the investment houses, Merrill Lynch, Citibank, all those people, they have people that just research these companies and issue forecasts for them that investors take very seriously. So what I did is I took from the forecasts that are available, the 1-year forecasted earnings growth rate for year 1, and then for years 2 through 6, they had a 5-year, there's a 5-year forecasted growth rate for the next 5 years that's available. And then beyond that, for the long-term growth rate, rather than take a forecast, I basically said anybody that thinks they can forecast beyond 5 years is maybe they're right, but maybe they're wrong. And a more reasonable approach, in my mind, is to look at the last 10 years of dividend growth for the company and say, okay, the last 10 years should be some guide as to what the future holds long term. So what I did is I took the dividend level in September of 22, compared it to the dividend level for the company in September 2012, and calculated the cumulative average growth rate that those two numbers imply. This is a big, ugly formula that says this is what the two-stage growth rate means, and basically what needs to be done is these need to be operationalized, and then there's a function in Excel that basically says you can iterate towards the discount rate that makes that true. And these were the stock prices, the current annual dividend, and the consensus growth forecast for the companies at the point I did this study. So, for example, I'm just going to do one elite. The average stock price was $55.23 US. The annual dividend was $2.60. The consensus growth rate for year one for the company was 4.5%. The consensus growth rate for years 2 through 6 was 8.7%. And then the 10-year historical growth rate was 3.5%. And so that's just one example. And then operationalizing those with the magic of mathematics and a very powerful spreadsheet, basically came up with cost of capital estimates for the two-stage model with a minimum of 4.85%. And again, these are unadjusted for Hawaiian Electric, a maximum of 12.64% for Wisconsin Energy, and first and third quartile breakouts of 8.3 and 10.82% return on equity. So 50% of the numbers using this method fell between the numbers of 8.3% and 10.82%. After you go through all the math, there's a few tests for reasonableness that are typically applied. Number one being, do the CAPM and the DCF yield similar results? If they don't, if the results are inconsistent with each other, that calls into question either one or both of the approaches. Something is amiss in the data. And then secondly, are these results consistent with the jurisdictions reached in other regulatory jurisdictions? I took just a simple average. I weighted them 50-50, and I came up with a weighted average. You'll notice that the results are consistent. The average of one is 9.17. The average of the other was 9.19. Extremely consistent. I just took the simple average and used 9.18% as the average. Now, this is a range. You're free, the commissions typically look at these studies and look at ranges and say, okay, we're going to set it within this range or that range, and this is the number we're going to choose. But on the first test of reasonableness, it passes with flying colors. Very, very consistent results. Being that these are unadjusted results, they should give results that are pretty consistent with recent U.S.-Canadian ROE decisions. Now, I just picked the most recent year. This was not in the study. I pulled these numbers last week to see where returns were. These are not the numbers the companies filed. These are the numbers that the commission decided what would be granted. So very quickly, Alberta Electric Utilities in Canada was recently awarded a 9% cost of equity. Nova Scotia Power was awarded a 9% cost of equity. Maritime Electric Company was issued in Prince Edward Island, was issued a 9.35% return on equity. Fortis in British Columbia was awarded a 9.8% return on equity. Encore in Texas was issued a 9.7%. Xcel Energy in Minnesota was awarded 9.25%. Arizona Public Service, 8.9%. Duke Energy in South Carolina jurisdiction was ordered 9.6%. Alliance Energy was awarded 9%. Madison Gas and Electric in Wisconsin was ordered 9.7%. Xcel Energy in Wisconsin was awarded 9.8%. United Illuminating in Connecticut was awarded 10.2%. Appalachian Power in Virginia was awarded 9.5%, and the average of the decisions that I was able to find for 2023, and I had one data point in 2024, that average is 9.45%. So it's pretty much consistent with the 9.18% unadjusted that I had estimated. Very much in the same zip code. What this graph does here is it lays out by quartile the ranges of the CAPM study, second line down, the discounted cash flow results, third line down. The top line is the average of those two, and then the bottom line the bottom line is the distribution of the 2023 and 2024 decisions that were awarded. And you'll see that the gray and I guess that's kind of a yellowish orange. I'm not sure. I'm not an artist, so maybe somebody can tell me what the hue is of that. But that burnt yellow bar is the middle 50% of those ranges, and you can see there's a great deal of consistency across this and actual on-the-ground results that were awarded. In fact, the 9.18% is well below is about 50 basis points below the average of recent decisions. So that's where we landed for the cost of equity for CAPM and DCF unadjusted. And talking about risk adjustments, typically risk adjustments can be done two ways. One is the sovereign debt cost versus the equivalent U.S. debt cost, which is the approach we took. The other is to look at credit ratings of companies, and unfortunately Dominica does not have an assigned credit rating by S&P or Fitch or Moody's. So if we were to go that route, we would have to choose someone to serve as a proxy, maybe Barbados or someone like that. But being that we have data on bond issuances from Dominica, we decided to go that route. We could have used more bonds, but they all pretty much used yielded very similar results, so we just used the most recent Dominica bond that was issued. Maybe there's been one since then, but at that time it was issued in November of 2022. The country issued a 7-year note at a cost of 7%. Now, the equivalent U.S. government bond cost on the same day of November 18th, 2022 was 3.92%, which implies a 3.08% company risk adjustment that would get added to the number for the country risk. And in dialogue with the IRC and their consultant, they pretty much agreed that this was a reasonable estimate of that country risk adjustment. Company size adjustment, we did not have agreement, but so that was pretty much sidelined, but I'm going to go through it anyway, because I do think it is something that should have been considered, and it is valid. DOMLEC is microscopic in size compared to U.S. utilities in the comparison group. Compared to the U.S. utilities in the comparison group and U.S. public utilities in general, smaller companies are riskier. Some adjustment to the ROE to account for this difference in size is warranted. Typically, that beta that we talked about earlier captures a lot, not 100%, but it captures a lot of the risk inherent in companies. So the approach I took was to look at the betas for the peer group relative to company sizes, and if you look at a scatter plot of the betas versus company size, and I used plant investment as a proxy for size. Every measure you choose has issues. This seems to be the least issue-laden one that I could think of. You could go with kilowatt hours, but there's some companies that don't have a lot of kilowatt hours, and they have a massive company that has a very low profile, and they have to build a lot of plant for it, versus companies that have a lot of kilowatt hours because they got a bunch of really small customers and no big ones. So that's an issue. Number of customers has issues. Market capitalization has issues because of the mix of debt and equity, and there's other things that can found that number. So I went into the balance sheets of companies and said, okay, what do all utilities have in common? They all have to invest in plants. And this scatter plot shows indeed that the smaller companies in the peer group absolutely had higher betas than the larger companies in the peer group. And that equation, that the beta is equal to 0.75 minus 0.92 times the investment in plant measured in billions of US dollars, has a pretty decent fit. So basically the approach, you need to basically kind of say, okay, given DOMLEC's size, which would be way over here, very close to the zero line, the beta should be upward adjusted a little bit, and combining that with the market risk profile in there indicates that a company size adjustment of 79 basis points would be appropriate for DOMLEC. So all those three numbers, the 9.18% plus the country risk adjustment of 3.08%, and then the small company size adjustment of 0.079%. Total, in the study I conducted, that the appropriate cost of equity for DOMLEC would be 13.05%. Reasonable people can reasonably disagree, especially over things that are subject to interpretation and statistical variations and other things. So we worked with the IRC and their consultants to kind of narrow down differences. They had a result that was their initial result was very, very different. But there were some areas where we worked together and narrowed our differences, and these next few slides kind of walk through where that narrowing the differences landed. The IRC had a number of suggested revisions that DOMLEC and their board has reviewed and agreed to. Specifically, the ROA should be based on a cap-end formulation where the market risk premium is based more on a more short-term and broader market index. So the risk premium that was suggested was much smaller. And then the other major adjustment that was suggested is that the beta estimates should be adjusted for the mixture of debt and equity in the capital structure. So that adjustment was done. The company size adjustment was rejected. And after all of those revisions, this resulted in a post-tax adjusted ROE of 10.51% versus the 13.05%. So it fell by 250 basis points approximately. The adjusted results in terms of where things landed. Now these are adjusted with the country risk and the company size adjustment. And I've also, just for relevance and comparison benefits, also listed the three recent decisions that I was able to find data on in the region. So the DOMLEC study on the far right was the 13.05. The IRC I don't know what they call it, resolution or mediated result was 10.51%. The initial, that compares with a result very close to a result in Jamaica of 10.78%, 11.75% in Barbados in 2023, and Grand Bahama in 2021 of 12.84%. So we've landed at very much on the low end of the range, but it is within the range. So I think it's not a it's a pretty good result in my opinion. Especially there's a few issues that really factor into this. One is DOMLEC is not typical anymore with its 52% ownership by government. It's really kind of a hybrid, and so the comparison with a purely investor-owned utility is still valid, but it's a little bit blurred, and publicly owned companies typically, you know, profits are not their key driver, so something on the low end is not that surprising. And the other thing is, you know, DOMLEC is very concerned about affordability, and kind of accepting something on the low end of the range is something the board is agreeable to. And all of these results that boil down to what was presented in the consultation document basically showed that the cost of equity, I've got it broken out by the three tranches at government, Social Security, and private investors. Each of those at a 10.51% debt at the 5%, and then doing the weighted average that comes with an after-tax, results in an after-tax weighted average cost of capital of 7.95%, and then accounting for the income taxes that must be paid on the equity proportion, that increases the WACC to 9.82%. That concludes my prepared remarks, and I'm happy to answer any questions, although hopefully they can either be sent to me via typing or the microphone can be moved to whoever's asking it, because I am really having a difficult understanding the audio.
Thank you, Mr. Vinhage, for your presentation.